Big news in the food industry today. Kraft Heinz has announced it will split into two independent companies by late 2026, ending one of the most high-profile mergers of the last decade. Back in 2015, the $55 billion Kraft Heinz deal was supposed to create a packaged food giant that could rival Nestle and Unilever. But instead of growth, investors saw a 60% stock price collapse and billions in write-downs. To me, this feels like a textbook case of how chasing scale doesn't guarantee innovation. Ketchup and mac and cheese may dominate grocery shelves, but running a modern food empire requires more than nostalgia brands and cost-cutting. When Kraft and Heinz came together in 2015, it was hailed as a dream merger. Backed by Warren Buffett's Berkshire Hathaway and Brazilian private equity giant 3G Capital, the new company instantly became the fifth largest food and beverage firm in the world. The strategy was simple: combine iconic brands, slash costs, and squeeze more profit out of household staples. For a while, Wall Street loved it, but reality soon caught up. Consumers were shifting toward fresher, healthier foods, while Kraft Heinz doubled down on processed cheese and packaged meats. In 2019, the company shocked investors with a $15.4 billion write-down of its Kraft and Oscar Mayer brands, followed by more losses, including a $9.3 billion impairment charge in 2025. The promise of unstoppable growth quickly turned into a sobering lesson in overconfidence. The decision to split Kraft Heinz is less about unlocking hidden potential and more about admitting that the merger strategy failed. For years, management leaned on cost-cutting and financial engineering, but those moves couldn't mask the deeper issue. The brands themselves stopped resonating with younger consumers. Lunchables and Oscar Mayer hot dogs feel stuck in the 1990s, while Heinz ketchup and Philadelphia cream cheese are still strong but limited in growth. By creating two separate companies, one focused on sauces and spreads, the other on meals and cold cuts, the hope is that each unit can sharpen its strategy and attract investors who understand its niche. But to me, this also highlights a classic corporate pitfall, assuming that scale alone is enough. In consumer goods, brand relevance matters more than sheer size, and Kraft Heinz learned that the hard way. The breakup is both a reset and a warning sign. Kraft Heinz's breakup marks the end of a corporate experiment that promised dominance but delivered disappointment. For shareholders, the split could unlock value, but for consumers, it may not change much. Ketchup is still ketchup, and Oscar Mayer is still Oscar Mayer. What matters is whether these new companies can actually innovate instead of simply managing decline. To me, this move feels like a cautionary tale for big mergers. When the market shifts, size can turn from strength into weakness. But what do you think? Will splitting Kraft Heinz give these brands a second life? Or is this just a slow fade-out? Let me know in the comments, and don't forget to subscribe for more quick news on the world's biggest brands.